way I see it, it's the continued tug of war between hard data and soft data. The narrative that the economy is a house of cards creaking under the weight of inflation and nationalistic policy has yet to show up in numbers. If you look at aggregate consumer spending, GDP, wages, and unemployment, they continue to paint a picture of resilience. That's a key word this year. And now, with the Fed signaling a desire to reduce restrictive policy and support the labor market, we believe risk assets could remain in favor, especially given the relatively robust backdrop of a strong economy. And so, for more markets commentary, I'll pass it to Joe.
Yeah, I think just reiterating that main point that sentiment in the market as measured by traditional surveys and indicators remains cautious. And we do see that persistent wall of worry dominating the narrative. But yet, in a period where most of the headlines seem to be searching for what could go wrong, we saw all-time highs being reached during the quarter for the S&P, the Dow, NASDAQ, and the Russell 2000. So momentum has certainly continued and encouragingly been supported by fundamentals. This quarter was a third consecutive quarter of double-digit earnings for the S&P, and broader markets are still being led by those mega caps, with the AI build-out fueling both investment and realized revenues. Small caps during the quarter also saw broader participation in the rally, fueled by, as Anthony mentioned, rate cuts and the prospect of lower discount rates in a resilient economy. Despite these tailwinds, our growth strategies have trailed their benchmark in the quarter, primarily driven on a relative basis by that underexposure in the mega cap technology space. I'll start with a company we've talked about the last couple quarters on both sides of the coin, advertising technology company, The Trade Desk. So strong recovery last quarter, but Trade Desk found itself back at the bottom of the heap during this most recent quarter. Their second quarter results did come in ahead of consensus, but their guidance was below expectations as the ongoing macro and tariff uncertainty weighed on their large brand customers and sentiment for advertising spend. Also saw further headwinds as Amazon and Netflix announced an advertising partnership, which supported the bear narrative that Amazon is taking competitive share away from Trade Desk, which would likely weigh on pricing and multiples for the entire space. In a vacuum, we believe this deal is less about Amazon replacing Trade Desk from a competitive standpoint. They will both be partners to Netflix going forward, but more indicative of Netflix continuing to open up to as wide a range of advertisers as possible as they look to fulfill demand for their rapidly growing ad-supported customer tier. We do still see Trade Desk as a differentiated player and providing a strong value for their large brand customers and retail partners such as Walmart, Target, and Best Buy that have pretty clear reasons not to share retail and advertising data with a company like Amazon. We do fully acknowledge that there is a growing amount of investor fatigue in the company, which has long been known for consistent execution, but the stock is now very much in show me stories stages at this point. We're maintaining our position today, and we'll look to earnings in a couple of weeks to better gauge where sentiment and fundamental reality may be misaligned. Moving on, another company we've talked about a number of times over the past few quarters is Mercado Libre. They are Latin America's leading e-commerce and financial technology company. Has seen a modest decline so far through the quarter, giving back some of the strength that the company experienced during the first half of the year. Revenues and fundamentals were solid, up 34% year over year, driven by 40% growth in their fintech segment. But margins were slightly lower than expected as the company leaned into investments in marketing and free shipping initiatives. Argentina's economic recovery also saw some turbulence late in the quarter, but Mercado Libre does have a very long history of executing through the inevitable ups and downs that will come about during the region. Free shipping, expanded credit offerings, advertising, and the announced acquisition to unlock the pharmacy segment are consistent with Mercado Libre's track record of making long-term investments to both strengthen its leadership in a region and continue to drive further digital penetration.
And then I'll talk about Axon. After a strong second quarter, shares of the public safety technology vendor digested profit taking, in my view. And focusing on the fundamentals, which are the drivers of long-term investment returns, the company's displayed impressive growth at scale with 33% year-over-year revenue growth in the quarter, which is an acceleration from the prior quarter. And we believe that's a function of innovative product development across both software and hardware, as Axon provides its government and business customers with an integrated suite of essential safety technology, and then high customer retention and sales execution within a large and an expanding market. So we continue to like the founder-led company and the business model, which has defensive characteristics. We like the company's competitive positioning and the revenue upside potential from emerging new product categories and the potential expansion overseas.
I can start, and don't call it a comeback, but Tesla saw a strong recovery during the quarter, putting them back in positive territory for the year. Earnings were largely in line with expectations, but have seen this current quarter's expectations now increase as demand is being pulled forward for electric vehicles ahead of expiring tax credits at the end of September. The bigger headline for the quarter was newly proposed compensation package for Elon and his $1 billion open market purchase of Tesla stock midway through September. Pretty eye-popping numbers and still pending shareholder approval, but the deal, in our opinion, firmly ties Elon to the company for the next decade, with alignment on both operational and profitability milestones that don't fully vest unless the company's value increases nearly 6 times from today's value, and its EBITDA grows to be roughly 4 times larger than NVIDIA's current rate. Just to paraphrase the New York Times, saying the market value increase is a figure that many experts would contend is, quote, laughably impossible, while critics argue that the new compensation plan is just the company's latest publicity stunt. Those quotes were actually from 2018 in Tesla's old compensation package for Elon, which they went on to hit each one of the operational and financial milestones outlined in that prior deal. I think the lesson being that while the numbers look large on paper, skeptics should be cautious underestimating the impact of incentives, the importance of leadership and execution, and the long-term potential for Tesla as a company and as an investment.
I'll chime in on Shopify. Shopify, the founder-led commerce enabler, reported 31% year-over-year revenue growth, broad-based strength across North America, Europe, and Asia. I think largely dispelling the worst-case scenarios of tariff-related impacts on shopping activity. Management issued a stronger than expected guidance for the current quarter, and we believe that reflects confidence that management has in the company's value proposition to merchants, the confidence in the company's traction in the business-to-business and international merchant categories, as well as new product adoption. We view Shopify as an IT utility, providing the technology backbone to retailers so that retailers can focus on what they do best, namely merchandising and marketing. And then for the third contributor this quarter, I will call out NVIDIA. NVIDIA is the founder-led AI accelerator. They reported consensus-beating revenue and earnings, and management had called out, in their words, extraordinary demand, for their advanced chips and systems that are used to train artificial intelligence software and for machine learning applications. The US-China trade relationship remains a source of noise. Management has prudently written down inventory tagged for the China market, but if negotiations resume, if there's some resolution, we believe that any sales to China could present upside to Wall Street expectations. And so while we believe that the building block phase of AI, which we're currently in, could mature at some point in the future, if you look at NVIDIA's largest customers' earnings reports and follow their commentary, there continues to be a huge appetite for high performant and power efficient chips that NVIDIA provides.
Three hopefully quick points from me. We had a great quarter of company engagement and travel. So members of the team attended conferences in San Francisco and New York. Overall, I'd say management teams remain long-term optimists around the benefits of AI, which Anthony will touch on next, but also staying pragmatic on the time to deployment. I also had the opportunity to visit Tesla's Gigafactory down in Nevada and came away really struck by the scale of the facility, the level of activity, but also the demand for power in their battery storage segment. There were data centers for both Microsoft and Google across the street from each other, just down the road. And then the excitement behind the mission of Tesla that is really evident in employees at all levels of the organization. Secondly, market concentration remains very top of mind for us and for markets. Seeing a continuous debate on what Bain recently termed the remarkable resilience of big tech, as they have been uniquely positioned to reinvent themselves as AI companies, thanks to the data, the capital, and the talent that they've built up over the years. These companies do continue to invest heavily to maintain their technical leadership, but there is an ongoing risk that AI could introduce more layers of competition through new applications or potentially new form factors. We are active participants in the space, but always looking for where the world is moving and where the next opportunities may present themselves, which brings us to the last point. The IPO window has started to open back up, seeing deal activity up strongly from the last 2 years, and still a long backlog of well-financed private companies set to come public in the short to medium term, which we will be watching closely. But it's also important to call out that there are disruptive, transformative opportunities out there in the public markets today. In our portfolio, we still believe we're in the early growth phases for small cap holdings like Rocket Lab, which is a founder-led, vertically integrated space company designing space systems for strategic partners, but also operating more than half of the non-SpaceX launches in the US today. Or another company, Transmedics, which has really revolutionized organ preservation and procurement to replace coolers of ice and dramatically increase both the supply and safety of organs that are eligible for transplant. So as always, we remain curious and on the hunt for these companies who are led by exceptional people and are innovating and investing with that long-term mindset.
And so this past quarter, we saw a flurry of corporate chess moves as deals and strategic investments littered headlines. For example, NVIDIA announced a $5 billion investment and design partnership with Intel. NVIDIA also announced its intention to invest $100 billion in ChatGPT maker OpenAI. Microsoft signed a near $20 billion deal with cloud infrastructure provider Nebius, and Oracle announced a 300% plus jump in its contracted backlog. So companies are jockeying for compute capacity as well as optionality for what could come in the future. Power remains a primary constraint to AI infrastructure. Consulting company Bain estimates global incremental AI computing requirements could reach 200 gigawatts by 2030. That's a staggering amount. This is compelling companies to find creative solutions to their power needs across data centers, within data centers, such as server equipment, but as well as chips. A couple notables: Oracle signed a deal with Bloom Energy. Bloom Energy provides an alternative to electric grid energy for data center power consumption. And then recently, Microsoft made a splash with its announcement that they are testing microfluidics to cool chips that can often overheat in the training of AI software. Clients want to know, what are the implications of AI? We see three major categories. The first is digital labor, which we believe should drive operational productivity as businesses evolve workflows to harness the capabilities of AI. The second are smarter recommendation engines, which should mean more personalized and engaging experiences across the web. And then the third I'd call out is physical AI, which we believe will manifest itself in robotics, industrial robotics, and potentially consumer robotics, and then with autonomous driving. And so tying it back to Zevenbergen strategies, we see AI as a major computing platform revolution that could play out over the next 10, 20 years. And as a result of our growth philosophy and process, we continue to have exposure to the four main categories of AI investment opportunity: the building blocks, such as NVIDIA, the data vaults, the distributors, and then the ultimate beneficiaries. The market this year has donned a coat of Teflon. Negativity so far has failed to stick. Investors have looked through economic, political, and geopolitical turbulence, anchoring on strong corporate earnings and resilient consumer spending. Of course, smooth pastures from here are not guaranteed. So we're keeping open-eyed, forward-looking, and agile, and we continue to trust the management teams of our strategy holdings to navigate any lack of visibility. Wall Street strategists, have noted an environment of high dispersion and low correlation among stocks and sectors. As active managers, we welcome, this environment, these conditions, as a way to demonstrate our judgment, and our experience investing through areas of technological change such as AI, and as an opportunity to demonstrate our security selection skill. And so to wrap up, I wanted to share a lesson from the book, Same as Ever, which was the company's pick for this quarter's employee book club. The author believes, as do we, that investment compounding can perform wonders over the long run, as long as that is not interrupted. So it's important for savers and investors to not just think, but act long term by preparing for inevitable shocks, inevitable surprises in the short run, so they don't get shaken out, of the tremendous wealth creation opportunity, that technological innovation and corporate productivity can offer. So I appreciate all of your partnership with Zevenbergen, and like we've said before, the future starts today.